Good evening. Welcome to our presentation this evening. Thanks to you all who got here early. See some people joining now. Always a pleasure to do this webinar. This is our sixth, seventh year of doing this roundup. And looking back over the year that was, looking at the crystal ball and seeing what we expect in the years to come. Let's just call it what it was, Ryan. It was a challenging year.
Yeah, it certainly was.
We had the Fed doing what they were doing, raising rates, then plateauing rates and trying to get us to a soft landing with the economy. We had the Great Resignation followed by inflation around wages, supplies, you name it, some margin compression, EBITDA compression. But somehow, some way, you guys ended up with a heck of a number of deals.
Yeah,
An excellent average exit multiple for both the multi-location and the solo. I know it took a pound of flesh and a lot of sleepless nights, but I'll just start by saying congratulations.
yeah. Well, thank you. Thank you. I'm really looking forward to this. Great opportunity to look back on 2023, kind of draw as many learnings as we possibly can, and apply that to our outlook in 2024. Looking forward to sharing some great examples and learnings with all of you on the call here tonight.
Great. So as always, if you have questions, do not hesitate. Drop them in the chat. If we have a chance to get to them tonight, we certainly will. Otherwise, we will be back in touch with you over the course of this week. So with that, let's go ahead and get started. So we'll do a brief overview of who we are. I'm Kevin Compass, president and founder of TUSK. Excited to be here tonight. You can get my email and phone number there. Feel free to reach out to us anytime.
Yep. Thank you, Kevin. Ryan Mingus, managing director at TUSK Partners. Just celebrating my fourth year here on Friday of last week. So couldn't be happier for the run that we've had. And I think we did this on my third day on the job 4 years ago, very similar webinar. So this is year number 4 in my fourth year.
What a great anniversary. That's awesome. We've come a little ways since then.
Yeah, right into the fire. That's for sure.
So update on the team. So today, we've got $1 billion worth of transactions completed. It's a team with a depth and breadth of experience we believe is unparalleled in the industry. And the good part about that is we bring it all to our clients each and every day. Most important thing about the team is how vast we are and the experience that we have collectively as an organization. And on this next slide, what you'll see is the companies that we've worked for over the years. TUSK really lives in the nexus between investment banking, finance, and private equity, and dental healthcare, right? So on this slide, you'll see all of the companies and brands we have worked for collectively over our careers. And some things to note here, we have several team members that have worked on the buy side, meaning they were business development roles, trying to convince doctors to sell to them through unsolicited offers. And the great thing about having them on our team now is that they know what the tips and tricks are that are used, and now we're able to leverage that knowledge inside of our own organization.
Yeah, I think that in addition to the experience in parallel industries that are a little bit more mature than dental. So myself coming from ambulatory surgery centers, Yazin being in the broader M&A, healthcare M&A space, and continually looking for talent that is beyond just that of dental, to draw parallels into what's going on in dental. I think people talk about where are we in the consolidation phase of dental, and it's nice to have folks that have kind of been all the way through the 9 innings of a baseball game for lack of a better reference. But so that in addition to the buy side work, I think is really what sets us apart.
Yeah, I couldn't agree with you more. It's a great team. Count myself as lucky to be a part of it.
Yeah. Well, we'll just dig right into 2023. Certainly a lot to unpack here, a lot to celebrate, and a lot to learn from one of the toughest M&A environments maybe ever in the last 10 years outside of that of COVID. So with that being said, although it was a tough year for M&A, healthcare more broadly did a bit better, and dental, as usual, continued to outperform that of healthcare more broadly, and certainly all the other M&A markets out there. TUSK as a firm closed deals across 16 states, totaling over 50 locations. They're, literally coast to coast for us as an organization. We had a lot of activity in some of these states, multiple transactions. Geographies that continue to be attractive are, like, we love college football here at TUSK. So using that analogy, we call it ACC and SEC country, really continue to be hotbeds. Multiples are, trading at a little bit higher in those geographies. The macro tailwinds that are helping, Florida, Georgia, Texas, Arizona, where they're gaining population weekly, and it's a number that is tracked weekly. DSOs aren't stupid. They know that there's an opportunity to not have to fight population declines in those geographies, and why not deploy capital in those markets? Certainly going to be lower risk. So the folks in those geographies get the benefit of that, and as such get the benefit of a larger buyer pool, which will always generate higher returns and higher valuations the more competitive the buyer pool that you have. That being said, we still were able to get a lot of deals done in states like California, New York, New Jersey. That is, I don't want to say historically, but coming out of COVID had really been some areas where DSOs weren't extremely excited about deploying capital. The political labor laws out in California and New York, so that was interesting. But at the same time, we closed some really large and interesting transactions in California and New York that took a lot longer than we ever would have expected. And at times, quite frankly, we were concerned that anything was going to happen at all. But really a testament to the team and how broadly they went and how gritty they were in finding a buyer pool to ultimately find the right fit for our client. That wasn't just a great economic impact to them, but what we really truly do believe was additive to the industry more holistically. And I think that, patients will benefit, doctors will benefit, the selling doctor, and certainly the DSO will benefit from those partnerships. So I think one of them was 200-day close to try to get that deal done, because of just the dynamics of the politics that go on out there in California.
Yeah, when I look at this map, it's like a walk down memory lane, right? Remembering the deals in each of these states. And for me, the biggest surprise for 2023 was all the traction we got in New York and that we continue to have in that state. There are remarkable businesses up there that we're lucky enough to represent, and the multiples that you and your team have been able to achieve up there is frankly pretty breathtaking. It's a growth market for a nice handful of DSOs that want to stake a claim up there. Yep. And for the longest time, there just weren't that many DSOs that wanted to take on that geography. But today that's changed pretty markedly.
Yeah, a little bit more diving into these deals. So there were 15 unique buyers, which is actually the highest for a 12-month period in TUSK's history. 7 of those unique buyers were actually the first time TUSK had ever done a deal with that particular group. So that means either they were a newly formed DSO, which was generally the rule for those unique buyers, but there was also 2 opportunities with legacy DSOs that historically had not been competitive in our processes over the years that we were able to get deals done with. All 7 of those weren't exactly brand new DSOs, rather some were legacy, but the majority, 5 of the 7, were new DSOs, which come with their own challenges, which we'll certainly dive into here today. But it's always a slog to get a deal closed with the DSO for the first time, whether they're an existing DSO or a brand new DSO, because they need to get to know TUSK as our process on the analytics front, and then the legal and all of that. Really proud of the efforts that we had here, and excited about all the learnings we were able to take away from each and every one of those deals. 59% of our deals were general dentistry practices, and 49% of them were specialty, based on, we stacked up the total enterprise value of all deals that were GP centric versus all deals that were specialty. So pretty interesting. Coming out of 2021, we've seen a steady decline in the amount of specialty deals we've done, but I think that that's really just a testament to how hot the specialty market was in 21 coming out of COVID. Compared to GP, I think that these numbers are pretty settled in, and I wouldn't be surprised if 2024 looks very similar to this year.
Were there more specialty DSOs that were less acquisitive this year than previous years, or do you think, or did you see more specialty deals go to historically GP DSOs, right? So some of those businesses have been around for a couple recaps.
Yeah, it's an interesting question. I think that there were, just taking the average, I think there were as many specialty DSOs versus GP centric legacy DSOs that went pencils down in 2023.
Okay.
I think that I truly believe that the credit markets was like impacted all of these groups the same. And if their balance sheet looked a certain way and they had to go draw down on additional debt to get deals done, I think that banks were probably looking at them saying like the same thing. I don't care whether you're ortho specific or oral surgery specific or GP specific, your balance sheet looks the way your balance sheet looks, and I don't really care.
Yeah, the covenants are what they are, irrespective of which business line you're in. Yeah, this has been a fun trend to track over time.
Yeah.
And I'm with you. I think we may be settling into a 60-40, 50-50 type split.
But I do see more deals going to these more specialty clients that we represent going to a more specialty, multi-specialty or even GP centric that's making concerted efforts to acquire more specialty.
Yeah.
But I don't think that really impacted the split there, because these are just like as our clients are qualified, whether they're GP centric or specialty.
Got it.
So average multiples for group practices that we represented, it was 8.5. So that's multi-site, multi-doctor locations or groups rather. And for single location, there might be multiple doctors, likely are multiple doctors in our deals, but a single location was trading at 7.3 times on average. The truth very seldomly lies in the average. I mean, the range there is pretty wide. It's not that every deal traded between 7 and 7.5, and we ended at 7.3.
Right.
The range was pretty wide. We had some single location practices trading well above that, and some that traded well below that. It's all about the quality of the asset, what the seller's looking for, what risk they're willing to take on, what risk a buyer's willing to take on. So, I mean, the range is actually pretty wide, but the average is what the average is.
Yeah, often I'm sure you're asked, like, what does $1 million EBITDA trade for? The answer is it depends, right? Yeah. So on the multiple side, when we were looking back at the data, we are still somehow, some way trading businesses at top of the market ranges this past year. Not saying it was easy, not saying it's repeatable, not saying it's going to continue, but it was interesting in the face of all these headwinds, our clients still got multiples at the highest we've seen year to date. So it took a lot of work to get there, but I'm elated to see us able to maintain that high level of valuation given the market dynamics.
Yeah, couldn't agree more. And we'll unpack kind of what were some of the drivers of that, and as we're taking the learnings from that and applying it to our 2024 outlook. Just one point to note: we did work with one of our clients did form a new DSO as a result of their transaction. We always like to reference these. We have the luxury of working with really great entrepreneurial minded owners, and some of them wish to pursue being that initial transaction from a private equity group and forming a new DSO. And there's a lot that comes along with that. There's a lot that comes along with those transactions. A lot of clients come to us saying that that's what they want, but through our process, ultimately end up going with a strategic. But it is always cool to have one of our clients form and now be a buyer in the space that we get to work with.
Yeah, it's always fun when we help create one of these businesses and then ultimately sell them, connect them with some of our future clients.
Yeah, it's been great. So just briefly want to reference, some select transactions here. Just again, couldn't be more proud of the work that was done. You'll see the myriad of buyers that we have in each and every one of these deal tiles, but had great privilege of working with some amazing clients. Every time we get a deal done, we lose a client, but lucky for us, we build some great relationships along the way and get to see some of their friends come back and see us and kind of sharing that journey with them. 2023 lessons learned. I think a lot of these lessons learned you'll see applied pretty materially to the 2024 outlook. But first and foremost, the interest rate environment coming out of Q4 of 2022 had a very big impact on the buy side. With 40% of legacy DSOs going what we call pencils down, not even taking an opportunity to look at any deals rather, and many of them firing their business development teams. And you had asked earlier, did I see a change in GP-centric DSOs versus specialty DSOs with their sort of inquisitiveness or ability to get deals done? We saw it all across the board. Ortho-only platforms, oral surgery-only platforms, general dentistry platforms, a lot of groups going pencils down and business development teams being let go.
Yeah, we sit in a unique position because I know you get these calls and I get these calls from business development guys inside of these DSOs saying, hey, is there an opportunity maybe for me to come switch sides and work with you? You're like, wait a minute, we got a deal under LOI with you right now. Like this doesn't feel that firm all of a sudden. So we've had a front row seat watching this happen. And every DSO, it's funny with that 40%, some of them were still sniffing around deals, not putting bids in, staying busy, but not actually being productive. And then others were very candid with us, saying, listen, we really have to focus on our core business. We got to grow our same source sales. We got to focus on operations and invest inside the business before we can even think about growing the business externally. So there was that environment, and it is our expectation and hope that this year of pause will lead to some major infrastructure changes with some of these businesses that have sat on the sidelines. But it will also lead to an increased sense of urgency to make up for effectively a lost year. I mean, remember,
I hope so.
Well, I think it must, right? So private equity groups are always focused on the IRR, that internal rate of return. And if they put a donut on the board for 1 year because they're focused on same-store sales growth, which hopefully makes up for the margin compression that they receive from inflationary wages, et cetera, they've got a lot of making up to do.
Yeah, it kind of feels like what happened in 2020 with nobody being able to get deals done, and then 2021 being a great year. I mean, that's certainly what we are hoping for. We want to see all of these groups go out, recapitalize, and produce all the returns to their partner doctors that they've projected. We want that. We don't want these groups sitting on the sideline for a lot of different reasons. But one of the big takeaways I also think about this fact is we kind of knew which one of these groups were going pencils down well before they actually did. Which could and did save a lot of our clients a lot of energy and time and effort, because we kind of knew that the other foot was about to fall on drop rather on some of these groups, and we accounted for that in our process as in advising our clients. Additionally, we're going to know when groups are ready to come back online well before they actually do, and that's information that our clients get. Obviously, it's the value proposition that they're paying for hiring an industry expert that's well connected.
Well said.
So legacy DSOs are on notice. Failed transactions at the top of the market have spooked a lot of investment committees. So what we mean by that is there weren't as many transactions being done at the top of the market, that over $50 million of EBITDA size DSOs that we would hope for in any given year. There weren't as many that got done, and there was quite frankly, a bloodbath of deals that didn't get done. And these are well-designed DSOs, DSOs that had a lot of wind in their sails going into 2020, end of 2022, and really got taken at the knees when they went to market in the early part of 2023 to get their deal done.
So I wouldn't. So there's a lot of forces at work, right? So any DSOs has been stacking EBITDA in hopes of getting a return on that, just on the arbitrage. I think that they're likely in trouble. but it was driven by an increased sense of scrutiny around the buy side.
Yep.
Like if the dollars get much more expensive, like they did when the Fed was raising rates, they're going to be a little more cautious because again, they have to get that return. So they really wanted to invest in businesses that had that great story, great history of financial return, and we're putting up good EBITDA margin with an opportunity for continued growth. So yes, there were certainly some big transactions that did not make it through, but they're going to get a second chance here in 2024.
Yep. But what we meant by investment committee specifically, we just want to focus there on, each one of these DSOs and private equity groups have a committee that they have to go to. And the transactions that were successful in 2023 at the top of the market were at multiples that were probably lower than what they had expected. And as a result, investment committees are less than likely to put forth the same type of multiples for those very, very, our clients that are 3 million of EBITDA and higher. Felt a little bit of, if there was any softness in the market at all, it was at our clients that were over 3 million of EBITDA that were going to require a very big check size, that had a lot of integration risk and just all the things that come along with purchasing a very large asset. And that's where we saw the softness for our clients out there, which we feel is going away and started to already go away because, to your point, these groups need to grow.
Yeah.
So new DSOs have really bolstered the buyer pool. I'd mentioned before that there are challenges that come along with closing deals with new DSOs and DSOs for the first time that we've ever closed. So that's really the lesson that we learned here. We were thankful to have all of these new entrants into the market. Usually starting out, groups can afford to pay a little bit higher with the intent of dollar cost averaging down and growing same store sales in the subsequent years. So year one, they can be a little bit aggressive, which was well received by our clients. But I think the biggest takeaway is, we had to make sure that we took control of the closing process. We needed to make sure the QV firm that they were being used was somebody that knew dental.
Yep.
There were a couple instances where DSOs tried to close a transaction with us and the QV firm had zero dental experience, and we had to coach them up and tell them where to go to make sure that they had somebody at the table that could actually get their deal done. And I think based on our experience in the market, they were willing to take us up on that, which I don't think is very unique outside of this space.
Yeah.
Fit matters more than ever. So, good buyers are not just interested in acquiring EBITDA. They really need that story to go back to their investment committee that shows the pathway to growing this asset and that they are well suited to unlock all the upside in your business. And that's what our job is at TUSK, is to find out what those opportunities are. We're not going to be highlighting things that aren't achievable. Like we're here to make sure that we're framing the story accurately in your favor, and additionally keeping an open mind and seeking out every possible buyer so that we can hear when somebody says something and we have a perfect client in mind for them, and we make sure that we highlight that accordingly. So the story has been really, really, really important, and not just the story, but do we have the data that supports that growth can be unlocked? Is there some sort of trend that we can point to, and all of that?
Yeah, well, we were just onboarding a new client about an hour ago, and the way I shared it with them is we're going to go really, really deep early in our diligence so we can completely understand your business. No business is clean, is 100% clean as a whistle, and there are going to be bumps and bruises along the way. But what's important is that we identify them now and prepare the reaction and response to the market in a positive light. So so let's say we lost a doctor. Yeah, we did lose that doctor. We've actually recruited, we've replaced him with this better doctor. Here's his production by provider report for the last 90 days. You can see that, hey, this is actually going to be an additive lift to production, collections, and ultimately EBITDA. Because buyers are trained to identify risk, and left to their own devices, they're going to seek out risk, which will be converted into a decrease in multiple and total decrease in enterprise value.
Yeah. Biggest takeaway. I'll start with this because this is the last minute ad on my part. I just think it's important to recognize how bad the M&A markets were across the country last year, globally. Globally. And then you can narrow it down to healthcare. Well, healthcare wasn't as bad as all M&A. Okay. And then, you've got all of our data points here on dental M&A, and it's really just a tribute to, and another data point in favor of dental being a great environment, a great investment, a great place for private equity to continue to want. They're continually attracted to, and that there is upside in a lot of these businesses, and that there is really value in consolidation, for a myriad of different reasons. But I just think our results from 2023, in the reality of the terrible M&A markets globally, I think is just another testament to how great the dental environment is, and how private equity continues to be attracted to it.
Yeah, it was a shining star, right? In a tough M&A world, dental continued to perform very well in the lower middle market.
In the lower middle market. So here's what most of you probably came here to weigh in on. So we'll spend the last 25, 30 minutes here looking at the outlook on 2024. It's always good to talk, macro. What are some of the tailwinds that are in our favor coming into this year? Well, there were three very meaningful recapitalizations at the top of the market last year. So you had DCA completing a recapitalization. So Harvest Partners stayed in the deal and brought on Mubadala. That's an interesting thing. We've started to see some changes in that organization. Usually in the wake of one of these recapitalization events, there's some changes in leadership. We started to see those take hold. So really excited to see how DCA settles out. Great headwind, great, one of the biggest DSOs in the country, getting that recapitalization done. Next, we had Lone Peak, which was sort of out of the Rocky Mountain, US, and they completed a recapitalization with BlackRock. This was actually BlackRock's second DSO. They did Paradigm late in 2022, so they're certainly all in on the dental space, one of the largest private equity groups in the world. That's also a good signal for our business. And then you've got Lightwave that partnered. Alpine exited their position. This was a sort of a mid-Atlantic general dentistry business, one that we were pretty familiar with, just being in the Carolinas. But was really excited for all the leadership there and some those founding doctors that we've gotten to know very well over the years. These are the great tailwinds that we have going into the year, and hopefully in 2024, starting in the first half, we know based on conversations that we have with leadership at all the largest DSOs that we've got at least 5 on our radar that we have been notified that should be recapitalizing in the first half of 2024, which would be incredible if we can start the first half of the year off with 5 of these.
Yeah, and all the bulge bracket investment bankers that we speak with are very bullish on the second half of this year as well, with respect to deals over $50 million of EBITDA. So we have the year that was, we expect this coming down the pipeline. So what can you do? Well, all these businesses that will be recapping are likely going to be thinking about how do they window dress their business in anticipation for this sale. Meaning, how do they add additional groups and individual practices that, yes, they'll get an arbitrage on, but they'll likely be paying a little bit more than they traditionally would because they're so close to the finish line. So I expect to see M&A activity pick up a lot here in the next couple of months.
Don't want to just lead with the tailwind. Certainly want to discuss the headwinds. So, on a macroeconomic level, we're all hopeful that interest rates are going to go down. Maybe in the first quarter, maybe not. But after seeing all the increases that we saw in 2023, all indications show that in 2024 there's going to be some decrease at some point, and I think that will be very, very well received in our world. Is there still a recession looming? I mean, most would say that we're on track for the only soft landing ever at sort of the Fed's navigation, and if that is the case, well, tip of the cap to them. when we look back a year from now, whether they were ever able to achieve the first soft landing. So good for them. Inflation is still existent. I think we've been doing a lot of research kind of in preparation for this webinar, and everything that we could, white papers, listened to some podcasts, read some articles. And I think when we were on the topic of inflation, it was really interesting that a lot of folks just feel that it's kind of pocketed, and it's pocketed in certain industries, and it's pocketed in certain geographies, and it's not all equal and uniform across the country. So that was kind of interesting to kind of think about, but it does make a whole lot of sense that, it's not all created equal, and some things are going to be at higher inflation rates than others. But it's certainly something that does spook private equity world, as kind of wage inflation being the biggest one in the dental community and dental businesses. Debt markets, you want to take a swing at that?
Yeah, sure. So debt markets have been thin. I was just on the phone with one of the largest lenders to the DSO space, asking him about his year, and he said, well, it was a bumpy year. We're hoping for a better year this year. The reality is traditional banks like Bank of America, Wells Fargo, pick your favorite large bank, they got spooked. Their credit teams got really, really spooked, and they didn't want to lend into an ever-rising interest rate environment because cash flows from businesses was down. What we've seen here in Charlotte, the second largest banking hub in the U.S., is they are still laying people off from these jobs, the leverage finance jobs, the credit jobs. Not a good sign, really, right? So what happened? Well, private credit entered the market. We saw a lot of private equity companies build private credit units and begin lending directly to private equity-backed groups or other institutions. Interest rates way north of 10%. The thinking here is that this is short-term liquidity to allow them to execute on some short-term strategies like M&A acquisitions, working capital, infrastructure rebuilds, in hopes that they can then refinance this debt off their balance sheet once banks get back in the game. Banks will get back in the game. They have to. That's how they make their money. The question is when.
Yeah. Right? Starting to see, at least I've seen a couple articles on, the competition between traditional bank debt and private credit. And on a couple deals right now, public businesses that are trying to be taken private and where they're going to get access to the debt for that. And there's a competition right now between, banks versus private credit. So hopefully that's favorable for the DSOs that are out there that have potential, two avenues of funding their deals. And they've got two competitive people or two competitive groups at the table. That should, be favorable for our world.
Yeah, I think so. I think private credit's here to stay. I think there's too much private equity dollars. There's a big overhang of those dollars. There needs to be a utilization for them. Here's a relatively safe, stable way to put that money to work with a known return and compete against the bank. So two pools of liquidity is always better than one if you're a business owner.
Do you think it's worth educating folks, informing people on this in case they don't understand what private credit is versus bank debt? Because I don't know if it's intuitive to everybody on the call. A lot of our clients, when they're, when we have these conversations, when we're in market, when we're asking about where the sources of capital are coming from, our clients don't always know that. So it'd be maybe interesting.
Sure. So traditional bank debt is when a banking institution uses its balance sheet, its assets, and loans those dollars to you at some rate, and they're competing for those for lending those dollars to you among other banks, and that was one of the major source of liquidity inside the U.S. economy. When those lending institutions froze up during COVID and coming back out of COVID, and their credit teams decided they couldn't decide when the bloodletting was going to stop, private credit stepped in. Private credit is a function of private equity companies lending directly to companies at much, much, much higher interest rates with flexible terms, amortization, and maybe interest only to fill the gap. There was a major gap on capital needs inside of both public businesses and private businesses, and private equity stepped in and tried to solve that need. So again, a source of liquidity, and that is just much, much, much more expensive.
Yeah. But at the same time, it was used at a rate that wasn't really seen before, and now they might have a greater appetite for it at slightly lower returns, or lower interest rates. They might be willing to lend to it. So at least I've seen that in a lot of the articles that I've been in preparation for this. So operating environment from a macro perspective continues to be, labor markets are what they are. Hopefully, hygienists wages are kind of plateaued, and maybe we'll see a step back once, some things settle out. But as a general rule, the operating environment will continue to be something of a concern for buyers, and it's our job to highlight our clients' businesses that have that low turnover rate, the high tenure rate, and have a great track record of navigating their business through a difficult operating environment to get them comfortable, because it's easy for them to look at the trailing 12-month period. But our job is to not just look at the trailing 12-month period, but also tell the story of this business that's been around for 15, 20 years, right, and all of the things that they've navigated throughout the course of building this business, to highlight and make sure that we're framing up a business that's kind of lower risk versus any other asset that's out there. Okay. So dental deal structures are changing. I think this was sort of just indicative of the lending environment, interest rates going up, and all of that. So deal structures have changed. Hopefully they've kind of settled in, but there was a learning curve for us as buyers. We're going back to their investment committees coming out of 2022 in the face of rising interest rates in having deal structures change from DSOs and that we've seen pretty standard. We've just gotten to know their structures pretty well and started to see meaningful changes, and had to get an understanding from each and every one of them as to why and how long is this here for, is this here to stay, et cetera. So deal structures have changed in the dental space on the M&A front. Greater scrutiny from the buy side. So that's back to the investment committees. They're putting everything under a microscope, not just once, but they've pushed closing timelines because they need to see an additional month because a provider left or a new provider came on, or any number of reasons. Investment committees are asking for one more additional round of data. Luckily for folks that use us, we've got all access to that. We can turn it in a timely manner. We can scrub the data. We can work with our clients to understand that data and pass that along in a timely manner and get the deal done, hopefully without too many rounds of that, if any. But greater scrutiny without a sophisticated advisor and firm on your side will certainly put a deal to the test and likely be the result of it failing.
Yeah, you've got the investment committees, and you also have the lenders playing a much closer role in this decision making. So if something's going astray in another loan with another portfolio company, or something's not working out with a recent acquisition, that lender may want to take a closer look at the next acquisition and the next acquisition. So there's a lot of decision makers at the table who can slow down a process right now.
Yep. Valuation settling, bid-ask spread. Doesn't matter what M&A market you're talking about or any transaction, they're always referencing, the bid-ask spread, the seller and the buyer having to come to terms with, what is an acceptable valuation for them. This affected some deals more than others. I think I had mentioned, the very top of the market. There was a pretty wide disconnect on a number of deals, not all of our deals, but a number of our deals, kind of over, call it between that 3 and 12 million of EBITDA range, where buyers knew that the check size needed to be, it was going to be large, and the level of scrutiny, that these investment committees put under, where it would have easily yielded double-digit multiples, those were much harder to come by. And hopefully we feel like both buyers and sellers in 2024 on deals of that size, the gap between that bid-ask spread will be smaller, and more deals can get done at those sides.
Yeah, I think it's got to give from both sides, though. I think it's got to give. The buyers will have hopefully more affordable capital that allow them to stretch a little bit, and sellers at that level will come back a little bit down within the Earth's gravitational pull and say, well, maybe I won't get a 14 or a 15 this time, but I and my investors will be comfortable with a 12 to 13x deal.
Yep. So we got struggling large DSOs, been called a number of different things, and sort of, if you're out there consuming content like this, we prefer the term zombie DSOs here at TUSK.
Yeah.
So there are DSOs out there that have gone out, accumulated, and just because of COVID, because of the interest rate, in 2020, because of the interest rate environment coming out of 2022 into 23, have just really stalled in their M&A activity. And all of these businesses are designed to grow through M&A. And if you're not putting up double digit, growth year after year after year, your ability to get to that internal rate of return that's going to get all of your limited partners excited about you transacting is harder and harder. And now you've got this proxy battle inside this organization that, you've got doctors that want returns because they rolled equity. You've got limited partners that want return because they supplied the equity to start the DSO. You've got banks that need their return, and it just creates an environment where it's kind of like paralysis by analysis, for lack of a better term. And these DSOs aren't able to get deals done effectively because they don't know what direction they want to go. But they're out there operating, out there, maybe being inquisitive and looking at deals, but maybe not, and maybe they haven't closed a transaction in forever. But regardless, they're struggling large DSOs out there that you need to be aware of. And we at TUSK know who those are, so we can navigate those waters for each and every one of our clients. But it's something to look out for. It's not anything that we want to see as an for the industry.
Yeah.
But it is a reality.
Yeah, I mean, I'm really very, very hopeful that the time and energy they spent on their businesses this year pay off, frankly. Look, there were a sizable number of businesses that were just gobbling up anything they could that had any EBITDA without much thoughtfulness around how they were going to integrate those business, how are they going to ring out synergistic savings, how are they were going to create a connective culture inside those businesses. And they've had 12 months plus to do that.
Yeah.
And the hope is that on the other side of this, that the zombie wakes up, right, and it turns into like a real business with a better value proposition, and ultimately will be better for the industry nationwide.
Well, just like there are private equity groups that are really, really good at taking a business from 50 million of EBITDA and taking it to 200 million of EBITDA, there are private equity groups out there that are really good at turnarounds.
Yeah.
So, there's a buyer for every seller. It just is a matter of time, and hopefully when those transactions happen, it's additive to the industry because you've got a new capital partner in that business that's there to do a turnaround versus, kind of pick up a business that's kind of on autopilot and not really set to launch. So, and then finally, we've got focus on EBITDA growth. We've talked about it a number of times. Like, it's not just about the numbers, it's about the story. But if you are being, focused on the numbers, it's not about top line growth, it's about same store EBITDA sales. So that's the large struggling DSOs that are out there. They've turned off their M&A machine, and now they're focused on same store EBITDA sales growth at each one of their locations.
I think about the evolution of how people had introduced themselves or benchmarked themselves for success. And years ago, it was I'm Kevin Cummins. I have 6 locations, and there was a belief in the market that mattered. I think we all know now that it did not. And then I have same store sales of 30%. Well, that's wonderful. What's going on the expense side of the income statement, right?
Yeah.
Because profitability ultimately is what drives all this. And we've had multiple large top 10 DSOs come to us and say, listen, this is the metric on which we are going to be measured in the market. And it's the metric that we're going to be measuring all future acquisitions on going forward. It's what matters most to us now.
I mean, that's just the maturation cycle of this industry relative to, other groups. It always starts with a land grab. There's not a lot of integration. And at some point, the tipping point happens, and it is about EBITDA. It is about integration. It is about growth. And it's not just about land grab because there aren't as many assets out there to gobble up. So this is just the maturation cycle of where we are. We've seen it before in other industries. So it's kind of interesting to be involved at the tipping point where we are right now.
Sure.
So 2024 forecast, obviously valuations are what a lot of people here are interested in hearing about. So, certainly there will be groups that are paying more, but there will certainly be groups that are paying less. You hate to give the consulting answer, and we'll certainly unpack this for what that means, but that's the reality of it. And we're kind of looking forward to sharing our insights as to lower versus higher. So reasons for lower is some groups, their cost of capital situation isn't going to vastly improve in 2024 versus 2023. I mean, we hope that most will, and in which case they're able to go back to valuations that of 2021, 2022, but not everybody's going to have the ability to go out and get a much cheaper cost of capital. Similarly, access to capital, depending on what their balance sheet looks like, depending on what their same store EBITDA sales looks like, it's all going to depend on what banks are willing to lend to them. So access and cost are kind of one and the same.
Yep. Well, we're getting calls now from groups that we admire who have access to capital issues and maybe covenant issues. They're not across the line yet, but they could be close. They're saying, look, in order for me to execute on a strategy that gets us to a return that's good for all shareholders, we're going to divest of some of these assets. And they're great assets, but they don't fit the strategic core anymore. And they're not doing that because they're bad assets. They're doing that because it frees up debt capacity, and they're able to draw down on that debt again to grow in markets they think will be better received by the future buyers.
Yep. Where are they in their recap cycle? So you'd mentioned, this earlier, Kevin, some of those groups that are looking to recap in the second half of 2024. What is that going to do for the deals that they're looking at this year? What kind of deals are they looking at because they're set to recap versus just coming out of a recap? So understanding where each and every buyer is in their recap cycle will give signals to valuations that they're able to do. Groups that are early on, just coming out of a recap cycle, they can afford to pay higher multiples for X, Y, and Z reasons. One of those reasons being they have a longer period to grow and unlock all of the growth that lives in that business. So the EBITDA grows and the effective multiple that they paid on that business is averaged down over time. Alternatively, if you are really close to recapping, you can afford to pay a multiple that's going to create and generate arbitrage for you and all of your investors and kind of sprint to the finish line and have a slightly higher multiple than you were, let's say, at year 3 of a five-year cycle, where you started off hot and heavy and you closed a lot of deals in the first 2 years of your cycle, and now in year 3 you're really in digested mode. And it might be a group that was really hot for a long time and has all this buzz and, but their offers are just significantly different in year 3 than they were in year 1. And that's okay. That means they're probably being responsible in how they're deploying their capital and preparing themselves to go to market to create a great return to all parties. So where they are matters and certainly will influence whether they're on the lower or higher end of the range of valuation. Not in the target acquisition profile. That's what TAP stands for. So what's the target acquisition profile of that DSO? All of these DSOs are forever changing. Every 6 months, you'll see a DSO change their tune on what they're looking for, either get narrower or broader in their focus. So understanding what their target acquisition profile is and where you fit into that at that point in time. Yeah. We always say, like, if I take you to market today and I get 5 offers from 5 DSOs, they're going to look one way. I could take you to market 9 months from now, get 5 offers from those same DSOs, and they're going to be spread out very different.
Yeah. I mean, this is why we spend so much time on the phone with the buyers, to understand what they're looking for when. Because when someone calls and says, "Hey, I've got a Medicaid pedo practice in California," there's a buyer for that, but it's probably not the same buyer that was there last year, to Ryan's point. The other thing that we've noticed is the 5-star assets, the great, large, growing businesses with infrastructure, with a leadership team that's committed to a growth strategy in the right geography. They're still commanding really high multiples for those. Whereas if a business maybe in the right geography or has a payer mix that's viewed as less favorable, or has faced a year or 2 of flat to declining revenues, we'll see many fewer offers, and sometimes we'll survey the market and realize that there's no appetite for that at this point in time.
At that point in time, but we've taken deals to market, a year later, and completely different environment. So
correct.
That's why we're here to survey the market, and you're going to get an absolute truth as to what the market's bearing for your business at that juncture, and we can collaborate on all of that. Less favorable deal structures. I'll focus is more on less favorable EBITDA calculations from these investment committees. So they're layering in inflationary elements, or
Wait, can you unpack that a little bit and help everybody understand what that means? Because we've seen it a couple times.
Yeah, we're just seeing buyers come back, and we're incredibly diligent when preparing our clients to go to market. We rebuild their financials from the general ledger up, and we find every single penny of, add back that is going to be defendable inequality of earnings. And we're not putting pie in the sky things out there for our clients. But the things that have been coming back from some of these investment committees and the EBITDA calculations that they have is comical.
Yeah,
quite frankly. And it just creates a really large gap that we have to navigate. And that's what we're here for. We're here to do that. We understand this job is hard, and getting deals done is really difficult. But that being said, the starting point that some of these groups are coming out with is really funny. And like the valuation that a group is putting forth is materially less than the other 4 offers you have on the table. And you try to get rationalization as to where they came up with that EBITDA, and the things that they've burdened this business with on a pro forma basis is just funny.
Yeah, so they're happy to burden it on a pro forma basis, but unwilling to give you lift on a pro forma basis. And the net result is lower EBITDA from their perspective. And even if they apply the same multiple to that lower EBITDA, they're going to be out of the conversation.
Exactly. Yeah, they might try to work around with some fancy earn out and all of that. And that's what we're seeing on a lot of these unsolicited offers that are out there. But our job is to capture as much of that valuation in the enterprise value at closing, to ultimately yield the highest amount of cash and equity and all of those things, so you don't have to fight for them in the 12 months post close.
Yeah.
Higher risk asset. So if a business has, is kind of outside that target acquisition profile for them, they're going to view this as a higher risk asset. And as such, they're going to not be able to put forth the same type of multiple for them. Reasons for higher valuation. The first 2 are the same. There are kind of the haves and the have-nots out there. There are some groups that have balance sheets that look a whole lot better than others. There are some that have same store EBITDA growth that looks great, and banks are more than happy to lend to. But this is really a tale of have and have-nots, and the things that come along with that. But if they've got great access to capital at lower cost than that of their peers in a competitive process, that's going to bear out in the valuation on behalf of our clients. Where are they in the recap cycle? Again, same bullet as the one before, but it just depends. Each one of these groups are at a different place in their journey, and when you cross paths with them, you're going to be, a different asset in their eyes.
Yeah, this is why I'm really excited about the top of the market this year, right? The 5 deals we have in the first half, 10 plus we have in the second half. Knowing who these folks are and how to interact with them the right way can really create a lot of value for our clients.
Absolutely. Again, perfect fit. So if you are the perfect fit and you cross paths with that group at the right juncture, which is our job to make sure that you get in market in a certain time frame, if we feel that we need to run versus walk versus crawl, whatever we need to do based on our pulse, that's our job. Sitting on dry powder, it's kind of similar to the first 2 bullets, but some of these groups have a lot of capital that they're ready to deploy rather. They either were newly formed in 2023 and ready to hit the ground running, or they just went through a recap cycle, or they just got an additional infusion of equity from their folks.
Yep. There's a lot of dry powder. I think when we talk about dry powder, we hear a lot of it in reference to the private equity dollars, right? There's a lot of dry powder there. Inside of these DSOs, they've got several ways to restock the balance sheet. Some is that divestiture of assets. That'll create some dry powder. Others is equity infusion. And the other is getting a new credit facility, right?
Yeah.
And we, trust me, we are well aware of when someone gets a new $300 million credit facility. They are quick to call us.
Right. Usually before the press release.
Yes.
And then a premium business. So if you're out there and you're building regional DSO, multi-site, multi-doctor platform, these businesses that have same store EBITDA sales, long tenure of employees, associate doctors with sort of some level of skin in the game, and all of these different things that stack up, that ultimately just de-risk the asset in the eyes of the
Right.
buyer. Like
Right.
when we say premium asset, it's really about you've created a business that has low integration risk and has a lot of upside, and the DSO that you're speaking with is best suited to unlock that for you. So that's the sort of the three boxes that you need to check when you're trying to determine whether you're a premium asset. And guess what? You're not a premium asset in the eyes of every single DSO.
Yeah, well said.
So like you could build the best business in the world, but if you go to market and there's only one group that you're a great puzzle piece, to fit their bigger puzzle, well, then you're only going to get one deal. But our job is to go out and find absolutely everybody, because we want to have that competitive process, and we want to create partnerships that are additive to the industry, that are kind of the win-win-win. Our client wins, DSO wins, and then we truly feel that that partnership is beneficial to the broader patient population as this dental market continues to consolidate and mature, so that it's a great place for us to do business at TUSK for another 10 years.
Yeah, great.
So the big picture, we kind of led with this, which is dentistry continues to be, 2023, the M&A world for dentistry can probably outperform that of any other M&A industry that I am aware of. If you talk to all the investment bankers that were laid off in other industries, or that focus on other industries, and even some that were in healthcare but not in dentistry, dentistry continued to be recession resistant, and groups were able to navigate these well, and we were able to see a lot of businesses do that and take them to market and let them be rewarded for that. It proved to be pandemic resistant before. So all of these things, and then capital craves safe havens for solid and predictable returns, which is exactly what dentistry did in 2021, 2022, and then in 2023 with a lot of our clients that outperformed the market. They took the wage inflation, the supply inflation on the chin, found ways to navigate that, grow their business, maintain margin, go out and make some add-on acquisitions while we were in market in a couple situations,
Right.
get those integrated and get rewarded for it. So I think having all those stories are really just keeping the big picture in mind, that based on the results of 2023 into 2024, I think you're only going to see a much greater level of activity on the M&A front, and hopefully at valuations that are above and beyond that of 2023. And just the takeaway is you guys are all building incredibly valuable businesses, as so long as they produce same store EBITDA sales, and have capacity to grow the businesses once you sell them. But really, I think again, 2023 was a great opportunity to look back and reflect on the difficult environment that was there. Look at all the successes that were obtained on behalf of our clients and others, and really be confident that whatever you're building is going to be well received in market whenever you decide to go.
Yeah, build a business that's built to sell, de-risk it along the way. Feel free to call us with questions around that, and then sell when you're ready.
Yep. Kevin, we're right on top of the hour, so I wanted to get this to you. What are you most excited for in 2024?
I'm ready for the Fed to do what they said they're going to do and start lowering rates. Right, so that's the top item for me.
Okay.
I'd like to see that happen. I also am really excited to see some of these larger deals trade. We need that vote of confidence in this market. I love to see the three trades that you profiled, but there's a stack of deals behind that, and they're gonna. We need some good news at the top of the market, and I think once we get a little good news, a lot of good news is going to follow, and these deals are going to happen in rapid succession, and that will give us kind of a new benchmark for where valuations live at that level. It could create a little bit of a reset of valuations in the lower middle market. It hasn't yet, proven by the multiples that you're able to achieve with your team, but it'll also add liquidity to a market that desperately needs liquidity to wake up some of these zombie companies. It is distinctly possible this year you will see some private equity company, some entrepreneur, some investor find a way to purchase, partner, or create value for those zombie companies in a way we haven't yet seen. I think that's going to be an interesting play that you'll see more of this year. I've talked with several entrepreneurs and investors that are kicking around business plans and ideas to get that done while still maintaining the integrity of the balance sheet, meaning making sure that the doctors who rolled equity into some of these businesses still get a return. Might take a little longer than expected, but still want to make sure that those doctors get a return.
Yeah, I don't have anything else to add to that. I think, I only had one, you had like four, but okay. So I had one thing that I was excited about, which you did mention, which is, the recapitalizations that are coming due in the first half that ultimately will feed the second half, is what I'm just most excited about. I think, we talked about the second bite of the apple all the time, and it's always great to see it come to fruition. It's just such a great storyline for the industry. And it just continues to show its maturation. So please contact us for a complimentary evaluation of your group practice. We'll analyze your business, provide you a free valuation range for the practice or group. We'll actually walk you through two distinct scenarios on going with DSO type A versus DSO type B. So you've got a good spectrum of what exists in the marketplace on whether that makes sense for you, your partners, and your families. And so you also have an opportunity to identify areas of opportunity, window dress the business prior to going to sale. We've had plenty of folks go through this process, come back to us 6 months later. We've seen the tide begin to turn, and then we put another 6-month date on the calendar, come back, do the process 6 months there, and then we're ready to go to market. And it's really awesome to see those come to fruition and get to hear those stories along the way. So happy to put our clients, any prospective clients, in touch with those clients that have gone through that process, because we understand that this is a journey and this is the sale of your life's work, and we're not here to rush people through that process.
Ryan, I can't thank you enough for your time this evening. It's been a really fun 4 years with you. It's been fun to watch you and your team grow and develop and continue to deliver such a high level of performance to the clients that you work with, that we're lucky enough to work with, and ultimately help them exit with the confidence at the top and without regret. So thank you for you and all you do. It's been a pleasure. I can't wait to do this again real soon.
Awesome. Thank you, Kevin. Appreciate the kind words. Thanks, everybody.
Thank you all. Have a good night.